Hello, guys. Welcome to the channel where I will talk about anything I want, but mainly taxes, tax strategy, Hex, Pulse X. And today's conversation will be in regards to staking rewards. I had a conversation with Rax and Riches, and the conversation went pretty well. I think that there were a lot of really cool questions that came through the Twitter Space chat, and we got to have some clarity about how specifically the Hex token rewards are going to be taxed, or in a certain sense, how we're going to treat it here in this accounting firm to report it in the tax return. Now, there's a popular stance out there, and I've heard it many times, where they give you staking rewards are like property created by the taxpayer, and they should not be taxed. And the example that is being given is that there is a tree, and you, as a farmer, let's say that you're a farmer, you have a seed and you plant it in the ground. Then you're gonna water it and do whatever it takes to grow that tree, and then it becomes a big apple tree that provides you with different apples. All these apples are non-taxable when you receive these apples. They are taxable to the farmer when the farmer sells the apples. Another example that is being given is as if the taxpayer is a baker, and he doesn't get taxed on the property created, like a cake, when he creates a cake, but when he sells a cake. Another example would be if a writer writes a story and he creates a book, he doesn't get taxed on the book until he sells the book. So in that case, it's a pretty good case. The staking rewards are property created by the taxpayer, especially if they're a validator, and they go ahead and produce all these different fees from receiving the fees from validating the blocks on the proof of stake network. And with Hex is a little bit interesting because although we're minting the Hex coins into existence when we end our stake with Ethereum. So we would technically fall under this category. Now, do we want to take that stance now? Maybe not. And the reason for that is because there's a case going on with the Tezos, and there's a family that reported their staking rewards as income, and then they sued the IRS requesting to get back a refund on those staking rewards because they made the claim as that the staking rewards are property created by them, and they gave the example of a baker. They make a pretty good case, and then the IRS try to settle the case by just trying to give them the refund without giving any sort of instruction or new legislation on how staking rewards are supposed to be taxed. Now, whether that stand is true or not, whether you want to make that political statement or whether you want to stay in that, it's your own problem. I'm going to talk about what the tax implications are currently with the instruments that we currently have, right? We only have a couple of tools to work with because there has been no instruction given as far as how staking rewards are supposed to be taxed, and whether, wrapping a token is going to be a taxable event because it's crypto to crypto, or whether burning or minting is a taxable event. None of that has been cleared at all. So we have to back up a little bit and see the broader perspective from a tax perspective as far as what is commonly used, right? So when we report interest, we are expecting to see a loan that you gave out, and therefore you're receiving interest for that money that you lent out. We're not going to report your staking rewards if you're receiving it from validating blocks on a proof of stake network. We're just not, because that has nothing to do with interest. So we would be in violation of the tax return if we reported on their interest. So then we have to see whether the participation of that activity is a business or not. Are you actively participating on the on that activity, or are you passively participating on the activity? And us as tax accountants, we have to decide whether that activity constitute as a business, and therefore you would be subject to self-employment tax. And if you're selling property, then are you subject to capital gains tax? So as far as the split, from all these different activities, how tax accountants are supposed to see it with the current legislation that we have, not on future stance or the best stance to have as far as what property is, because even if the Tezos case makes a good case, is not on legislation yet. The IRS hasn't said, oh yeah, we're going to go ahead and go through that. It would be nice, obviously, because we would all take advantage of this. But with current legislation as of February 18th, 2022, when we're going to do the tax return for the tax year of 2021, and even when we're doing the tax return of 2022 in 2023, we have to wait to see whether legislation actually changed or not. Now, we're going to go ahead and discuss a different type of staking rewards, and staking rewards are usually given in two different ways. By giving you additional coins in your wallet, and therefore you would account that as staking rewards. And the other way is that they give you a smart contract or a representation of your initial deposit that increases in value over time. And one of them is going to be taxed as capital gains, which is the smart contract that increases in value over time is capital gains, because then you execute the contract, or you sell the contract, or whatever it is that you got to do to get the additional tokens. That those additional tokens would be excess value on that smart contract, and they're from the initial deposit that you gave, and therefore those would account for as capital gains. The other ones, we can constitute them as actual income or self-employment tax. I will go into what constitutes self-employment tax as far as the income of the first additional coins, and then I'll go into what constitutes as a smart contract that increases in value for capital gains. The first one is going to be if you are a node operator in a proof of stake network. Simple English, you have a computer and you run a software program to process and validate the transactions on the network. And you have a bunch of different money that people delegate to your node. And those people are part of your operation. And let's just say that you only have a couple people, like 1-2 people that substantially participate on the delegation of your node. The node requires a certain amount of coins or money to be able to run the validator and process the different blocks. Sometimes, like in Polkadot, the validators provide 100% of the amount required to run a node. And therefore, they're substantially participating in the running of this node. And therefore, they're operating as a business substantially. And therefore, they would then be subject to self-employment tax. If the delegators of that money are in conjunction or working together with the node operator, and they have a substantial amount of investment required to run the node, then therefore they would also be subject to self-employment tax. Now we go into then like the validators that have 1,000 different delegators, people that give out their money for that. Well, in that case, all of these operation for the delegators, even the node operator, if the amount of participation is not substantial, very, very minimal overall, less than 20% of the shared pool, for example, then that would be a passive activity, and therefore you would then report that as just ordinary income. So now that we have distinguished that what qualifies for income and what is then subject to self-employment tax and what is not subject to self-employment tax, then we have other platforms that also do lending, and then they give you those extra coins, and that in case you're doing direct peer-to-peer lending, then that's active. If you're doing peer lending through a platform, through a custodian, then that's passive, and therefore it is actual interest. But you just have to verify whether your platform is actually lending out your money to other people or not, because sometimes it gets confused. And Aave, for example, is one of those platforms that is truly lending, and therefore you would classify those staking rewards as interest. Now, for the second part of the initial conversation that I started is that smart contracts that are given in exchange of an initial deposit that increase in value over time, and therefore the additional tokens minted or given to the staker are considered capital gains. And this is an important topic to understand because for hexicans, we may want to take this stance if we have long-term stakes for a preferred tax rate of the 15%, 0%, or 20%, depending on our income tax bracket. It could change with legislation, like I said, then this whole conversation goes out the window, and we don't have to worry about reporting this because it's actual property and therefore not subject to any type of tax because we created this property. But that's not the case right now, right? I'm not taking that stance with my clients because it's in the middle of a court case, and there's really no indication that they're going to go that way or not. So the stance that I'm taking right now is with the current tools that I have and how I can actually defend a certain position. Having that said, when the way that the Hex protocol works is that when you buy Hex coins and you want to acquire a smart contract, you have to think about this smart contract as a little piggy bank, right? And the piggy bank, imagine the pig, right? And the pig is literally made out of all your Hex coins, right? It's literally made out from the initial capital that you burned. And this pig is going to be either massive or really little, depending on the time. So if you have one t-shirt that you stake over a period of 5,555 days, the pig is going to be pretty massive. And the t-shirt that you acquired for only 1 month, when you indicate that you only stake for 30 days, the piggy is really small because it doesn't have that much more space to accumulate staking rewards. Now, what are the staking rewards made out of? The staking rewards, or the yield that we receive in the Hex protocol, is made out of two things. It's made out of penalties from other stakers emergency on staking their contracts and percentage of inflation. So Hex has a percentage of inflation built into the protocol that mints new coins into existence. So the way that it works is that we first burn our coins, we get a t-shirt in exchange. That t-shirt is going to accumulate daily Hex payout every single day as long as you're staked. And then when you decide, or when you end your stake, whether it's the time to unstake or not, you're going to mint new Hex into existence. If you get 100% penalized for it, obviously you're not going to be able to unstake any coins because you got penalized for it, and then you got paid out to all the different stakers. So now, if we were to consider that protocol, we initially deposited 100 Hex coins, we got a t-shirt back, and then that t-shirt over a period of time accumulated an additional 50 coins. That means that the t-shirt in itself has increased in value by 50 Hex coins, and therefore would be subject to capital gains when I exit the position. Whether you want to call it burning or minting, whether you want to call it that a t-shirt burn is a taxable event or not, the definition between burns and mints, like I said, it has not been defined at all. Or wrapping a token on a liquidity providing protocol, it has not been defined at all. So what we look at is the intention of the protocol. So if I'm looking at the intention of the protocol when I'm like over a bridge, for example, that I'm wrapping Bitcoin and then I'm wrapping it over just to bridge it and use it in a different network, I got, for example, BTC to WBTC, which is a wrap version. Then the question is that exchange crypto to crypto exchange and then a taxable event? Because we have to determine and establish here first that crypto to crypto is a taxable event. So will that wrapping be considered a taxable event? I guess it depends on the intention that you are using that protocol for. If it's just to use in a different protocol and to just bridge it, I don't think that that's a taxable event. But if the intention is to increase the quantity of your tokens because you're participating in some sort of activity, like if you had that seed, right? Like back to the example of the seed, and you just kind of have the seed and then you just wrap it in wax. I don't know how to, I'm just giving a BS example. You wrap it in wax and then, you use it, for whatever, reserve it, that's not a taxable event. I guess I'm giving a stupid example, but now going back, the intention of the protocol of like Hex is to actually receive more coins than what we deposit. So therefore, we can say that our intention is to acquire more coins and be able to profit from that. In this case, as we see the intention of that, and we see that the smart contract that we're interacting with increases in value as far as more Hex coins being deposited into that Hex smart contract, we can then compare it to other protocols like Compound and Yearn Finance, where they get, for example, on Compound, they get, let's say that you have 100 DAI. When you would like to participate in the activity to acquire more yield, you then get something called CDAI. You don't get more CDAI every day as far as a payout, but the CDAI or in other words, your share of the pool, then increases in value over time. And when you exit the protocol, then let's just say that it increased in value over time to the initial 100 DAI is now 150 DAI. The increased value, because you exited the position, would be considered a taxable event. And therefore, that would be considered a capital gain. That's just the way it is. If we then compare a T-share as a smart contract, in which case it increases in value over time as far as the Hex coin quantity, when we exit the position of the T-share, then we can consider that those extra coins are then capital gains. Now, I know that a lot of people are going to argue about it and that they don't like that stance. They would just continue counter arguing whether the T-share to Hex is whether it's a taxable event or not, because it's mint and burning, blah blah blah, whether it's property, all that kind of stuff. It could be true, it doesn't matter. But as far as the tax accountant is concerned, what we're looking at is just what is the best way to report your activity. What is the best way to report anything that you're doing in crypto? It's so complex that we're trying to make our best decision into how to file your tax return and for you not to get in any sort of trouble with the IRS. And there's other positions that say, well, I'm not going to pay any federal taxes at all because I'm a resident of my state, which is the federal exclusion, whatever. Well, good luck with that. Let's see if you can actually buy a house with a tax lien in your report, and whether any attorney would like to fight that in court. But look, there's different stances on this. The stance that we're taking here in the firm is that the Hex protocol is in the consensus of all the protocols that are very similar. When a smart contract increases in value over time, the extra coins that come out of it are taxed as capital gains. And we like that. We like that because the preferred tax rate in a long-term capital gain is either 0%, 15%, or 20%. And a short-term capital gain is just ordinary income tax. So you go back to the same old belief of staking rewards where they were taxed as just income. Now, I think that kind of summarizes my reasoning behind why Hex rewards are taxed as capital gains. I think that gives the community a good idea on how to report it and will give them the best tax treatment. If you're going to report your rewards at all, whatever. I do recommend that you report them. up until the point that the case on Tezos case, for example, or a Hexagon goes into court and fights this, and then there's actual instruction into like, no, staking rewards are non-taxable. Up until that point, then I would say, yeah, don't, they're non-taxable, great. I don't have to report my stuff. But currently, this is the stance that we're taking. And it encourages people to have longer stakes, longer than a year, because then they would have a 15% or 20% or even a 0% tax bracket on that. So that summarizes everything. I hope it helped everybody here in to get a little bit more clarity about why I'm taking that stance and why here as an accounting firm, we're taking the stance of having Hex staking rewards as capital gain. If you guys have any comments, any rebuttals, anything that you guys want to send my way, I would be happy to read it. I would be happy to have a discussion back and forth so we can go ahead and have a deeper understanding with current legislation about staking rewards. In other videos, I will talk about how to avoid capital gains, how to structure, different entities, whatever people want to know about whether an LLC is going to save me taxes or not, et cetera, et cetera. There's a tons of different topics that we can talk about pertaining to crypto and tax strategies. So yeah, see you next time. Bye.